We are live. Last week we took a 305% profit on Boyle. That's about the only darn thing that's gone up this year. And I'm expecting a new trade alert this week. We're most likely re-entering Boyle and at some point dumping our stock crash hedge UVXY. Our top selling advisory is now up 40% year to date for 2022. I think it did dip to 38 before we updated the slide deck, but still doing remarkably well in a year where investors are getting destroyed. Our high risk growth portfolio returned 233% total return in 2021, turning every 10,000 into 33,000. Strategy last year was very similar, no bonds. This year we've rotated into bonds. Last year we were playing oil. This year we're playing natural gas because we understand what Putin might do next, cut off electricity to Europe, specifically Germany, if we don't give him what he wants. So how to get rich in 2022? Buy these 4 stocks now before it's too late. 3 are a buy signal right this second. 1 we'll probably hold off on until maybe tomorrow. So, okay, trade 1 is a play that energy prices will go higher and higher as long as there's a conflict. And now I'm going to add the word escalating in Europe. Now, the reason why I say escalating is because Russia's finding new buyers for their oil and more production's coming online. So the rate of change of disruption has to continue to really drive these energy prices lower. In general, we're actually expecting a slowdown in the global economy led by China. Now, if you want to know why we're at war with Russia, this map explains it all. And they knew this. NATO knew this. They wanted this war. And here we go. We have a war. Red represents the expansion of NATO over the last 30 years. So imagine if the US had heavy-duty missile systems lined up on the borders of Canada and Mexico that were funded by China. Do you think we would just let that occur? Of course not. So who's winning the war? Well, the high energy costs are definitely helping out Russia currently. And we can see the only currency to outperform the dollar, period, is the Russian ruble. So I do think this war will not last too much longer because it's hurting the rest of the world far more than it's hurting Russia. And this is indisputable at this point. So last week I was saying, let's sell Boyle. We almost hit the very top. And I'm not trying to hit tops and bottoms, to be clear. We saw natural gas go above 8. Normally it's 2. It's outrageous. So we took profits. Thank goodness we did. It's crashed massively since then, getting ready to put you right back into Boyle because no side seems ready to end the war. In fact, Biden is out there pushing all sorts of legislation with executive order to speed up the ability to ship off money to Ukraine. And so the defense contractors love this, and all the corrupt politicians love this because it's a way to funnel billions of dollars out of the government when they couldn't get the Build Back Better plan passed. So, yep, it's a money pit. I'm not expecting the war to end right now in the near term. So Boyle will be back in play very soon. Pick 2 is a play that interest rates are about to collapse due to monumental fall in GDP from China's lockdown, from interest rates being too high, from the cost of energy being too high, and in general, no new stimulus coming out of the government for 18 months now. So the economy is starting to slow down. With that said, the consumer in the US is extremely strong. Okay, they are spending money and borrowing at record pace. So I think the setup for a rebound in stocks is very near. And which is why we've not told you to dump all your stocks and run for the exits. Here's a look at the bond market creating problems over the last 30 years. Every time interest rates go up too much, as debt grows, interest rates must fall. Otherwise, governments can't grow their debt any longer. And so the CPI coming out Wednesday, I believe, needs to start falling so that the Fed can start back talking all the hawkish talk, get interest rates to fall, and save the stock market. So a very important potential catalyst could be underway on Wednesday, as I am highly confident the CPI will begin to fall, even with this conflict in Europe. Now here's a look at all the ships stuck in China. So this is certainly being done to attack the United States by stopping the outflow of exports from China to the US. This is creating more inflationary pressure and crashing our bond market. It's also helping drive down the cost of energy, which they desperately need to run their economy. So this is a very, very fascinating disaster unfolding. Pick 3 is currently up 16,000% in the first 5 years, and is most certainly going to go up at least 400% in the next 3. We're very close to the point in time where central banks are going to have to start printing money and buying their own debt and manipulating interest rates lower. However they pull it off, once yields fall, that's really going to be the catalyst for tech and this pick to go up, which is Ethereum. Here's a look at its chart. It's down over 50% from its recent top. It could go lower. Absolutely. We'll talk about what's caused the cryptocurrency volatility in a moment. It's a stable coin attack, and it is very, very interesting, which we will again discuss in a little bit. But typically, this is a good time to buy at a 50% drop. Now, as the market share or market capitalization of Bitcoin has grown over the last decade, the volatility has slowly but surely reduced. So if we look at the 1,000,000% return you made holding Bitcoin over the last decade, you had to hold through some significant drawdowns. Okay, if you bought in 2011, you saw this massive gain only to watch it crash 96%. Then it rocket shipped up. But there's been volatility in the 80% range in the next cycle, leading into 2015-16. Had another melt up into 2018, only watch another 80% collapse. And now here we are in 2021, 2022, and we're sitting on that 50% plus drawdown. But again, the trend is less volatility as the market capitalization has grown over time. Now, ever since the massive money printing occurred in March of 2020, it's become extremely correlated to the NASDAQ. For the last several decades, or excuse me, for the last decade, there have been quite a few years where it was relatively uncorrelated to the NASDAQ. And if you think about it, when Foxconn gets shut down because of China shutting it down, that hurts its supply chains. But it doesn't affect the value of Bitcoin. So I do believe over time, as the market share grows for cryptocurrencies, probably needs to grow about tenfold from here, it will become less and less correlated to the stock market. Pick 4 protects your account against the stock market crash, made 1,000% gain in 2020. It was up 10% a minute ago today, 12.5% now. Here's the UVXY product. I would suspect it's time to lower our exposure to UVXY soon. And let's pay attention to that CPI print. If it's falling decently, Wednesday could potentially be a good day to drop UVXY down, and perhaps we look at BOIL tomorrow. So keeping a close eye on that. So what's creating all those problems in the market? It's the interest rates rising and the low liquidity. This is causing margin calls and all sorts of problems. And so first we saw commodities shoot up and catch a lot of commodity traders off guard. They were essentially doing the equivalent of selling call options and ended up in deep doo-doo when the war with Ukraine and Russia broke out, causing margin calls and people losing more money than they actually had. So they had to start selling everything. So that was the first big problem that developed this year. The ramification of the high energy costs was a crash in the bond market. So now we're all feeling the pain, delayed from the bond market crashing below, to be fair, levels I thought were even possible, which occurred last week. Now, the good news on both fronts is the energy costs have stabilized. The rate of change has flattened out. They're high, but they're not going up or down at rapid pace. And the bond market appears to have bottomed and stabilized. So we should be getting very near the end of the market volatility and start to get some dovish surprises from the Federal Reserve. Perhaps with the CPI print Wednesday, we could start to get some easing in financial conditions. So let's take a look at how we recommend you invest $10,000 today in our high risk growth strategy. Step 1, pick up 72 shares of UVXY. It's expensive, and we'll reduce it as soon as we can. Even though it seems expensive right now, this could be going to much, much higher levels if the market does continue to sell off from here. Step 2, buy 153 shares of TMF. This is the 3-time 20-year plus treasury product. You're betting on interest rates going down. This is a Sigma 3 move in bonds. It's basically never happened in the history of the US bond market. So unless you think the politicians want to stop borrowing money, it's highly likely these interest rates are driven down and very, very soon. So here's a look at the TMF on a chart way below the trend line. And again, the recent high was up in the 45s. We're picking it up at 12. So this could be, we made massive money on Boyle. I think there's room for Boyle to have one more upswing, probably in the next 30 to 60 day time frame. But the bigger trade is going to be TMF. So expect us to slowly but surely load up into TMF. And there's an alternative to TMF that could outperform if the right conditions are met. And there's 2 criteria to have an alternative to TMF, which we'll discuss in a few slides. This is an old slide deck. We're now a couple weeks further, but the percent decline and the duration of this bond market crash is the worst in all of history. Nothing like it. Step 3, buy 180 shares of ETHE. This is the Grayscale Trust. It's trading way below its par value. Okay, so we had someone go pull out all their money out of Terra Luna stablecoin, and to stabilize the stablecoin, which went below $1, they had to start dumping what the Terra Luna is backed with, which is Bitcoin. So, and this then caused another big DeFi protocol, Curve, to get emptied out. So massive amounts of money are getting drained out of DeFi, out of these stable coins. And this is causing massive amounts of selling in cryptocurrencies. Painful in the short term, but at this point, I would not react to that. I would not be selling our position. As you know, I'm expecting we're on the verge of essentially a reversion of how we've been looking at markets. So going from a value position to a growth position. Now, look, other countries are already having to do what we fear the US may have to do soon. Japan is already printing money like crazy, doing what's called yield curve control. And here you go, there's their currency devaluing at 20%. China is now printing money to protect their real estate market. They've been a little bit slower than one might think, but I believe they're going to have to aggressively flood their financial system to hit their 5.5% GDP target this year, especially after locking down half the country. Now their currency is starting to devalue. So the big catalyst for the dollar will be energy costs going down with yields falling and the dollar falling. This strong dollar and these outrageous interest rates are very problematic. The interest rates too high for the US to afford the debt service to it. It's looking at something like 25% of our tax receipts at this current interest rate would go to simply interest. And foreigners don't want to buy our debt when the dollar's so strong against their currency, because if the dollar were to drop faster than the interest they're making, they're actually losing money. So this is not a good setup at all. Here's the DXY index going straight up. So cryptocurrencies look cheap relative to the dollar, and that's due to the crises unfolding in bonds and commodities. So expect for the dollar to fall to get that big jump in crypto. And there's a lot of pain that can only be resolved with more money printing. So we still are predicting new highs in cryptocurrencies, despite having been in a 5-month pullback that's been extremely painful and hard to live through. But if you've been around the block in crypto, you know this is not abnormal whatsoever. And again, to hit the 1,000,000% return you could have had over the last decade, trying to time the market was virtually impossible. Step 4, wait to buy Boyle. I may pull the trigger tomorrow. Thank goodness we waited. Boy, it fell from 120 down to 82. And the war is not over. It didn't escalate. A lot of people were predicting Putin would announce all-out war and start a draft. But it looks like his plan is just to stay steadfast, drive up those energy costs, and make the world pay the price slowly but surely. So while 3% of the global economy is potentially having some sort of pain in Russia, even though their exports are at record highs and their currency is the only currency outperforming the US. The reality is the rest of the world is going to have much more pain from this. And so I do not think we will win this war. Here's a look at the breakdown of the portfolio. We have 72 shares of UVXY representing 13% of the count, 153 shares of TMF, and again, this is per 10,000. Treasury play, 18%. We have 180 shares in Ethereum, representing 30%, and BOIL's in cash. Now, just hold off. We're going to go back into BOIL. I'll update it with what the new number of shares will be. Remember, we sold BOIL at a much higher price, 114 to 115 is where I would expect most of you sold. So the number of shares that we can rebuy in BOIL will be greater than 40, to be perfectly clear. So we'll update that chart. For those of you in cash, stay in cash, wait for me to pull the trigger. Could be very soon. Bond markets causing this pain. Here it is. I suspect this is the bottom in the bond crash. And we're either going to load up on TMF or FNGU from the next sale of BOIL. And that's going to be based on whether the war is going to continue for a long, long time, or if we're going to have diplomacy. But either way, energy, the tightening in financial conditions is unsustainable. And we're going to have to see central banks save the day once again, or face a Great Depression. So here's the oil price coiling up here. Here's a long-term look at it. You can see it can get to these levels, but it sure as hell can't stay at these levels for long. So we want to be careful betting on energy costs being expensive. It's a very rare thing that doesn't last for long, and again, it takes very special circumstances. Now, the second the conflict does end, I would rather go long FNGU over TMF because there's potentially a greater return in less time. And so we've got this puppy's trading at 886. Thank goodness we've been patient, because what we're worried about for FNGU are high interest rates and supply chain issues. And so unfortunately, there's no change in the interest rates and there's no fix of the supply chains. That's why we've been holding back. As soon as we can see a clear path towards those problems being resolved, we're going to load the boat on FNGU. Okay, so we show this slide, and it's not fun to look at with the drawdown we're having in crypto. But the last time China went aggressively printing and we started a tightening process, there was a beautiful return in crypto, and it went really parabolic in the second half of 2017. That's really the way it is. It sits there and it's very boring, if not painful, and then it goes straight up, especially when there's low liquidity. And that's the environment we're in currently, is a low liquidity market. So watch our webinar every Monday, Wednesday, Friday, and be ready for buy and sell alerts. If you're on a free trial, upgrade by calling Dean at 505-322-7515. People are asking if the CPI comes in lower, it'd be good for FNG. On the interest rate front, it would, but not on the supply chain. So we can fix the financing for tech, but we can't fix the ability to produce their goods and services. And so it's, for some of these companies, it's mainly the chips. The neon coming from Ukraine and Russia is critical for creating the processing chips. And then the manufacturing of a lot of our products come out of China. So until China wants to open up their factories, and we need to get the neon flowing to the chip producers, it's going to be a hard play on tech. Okay, so here's what happened in the crypto space, and it began this weekend. Terra Luna is a UST, I believe, the fourth largest stable coin. It's supposed to be pegged to $1, and it's backed by Bitcoin. somebody went and pulled out all of their deposit at once, and it caused it to go below the dollar price. And Luna had to respond by selling its Bitcoin and Ethereum. And it's created margin calls across the board. People are being forced out, especially leverage players. And so it's quite normal. Uh, and that's what you have to be willing to stomach if you want to be investing in growing emerging markets. And so that's what's happening. It's not fixed. They're trying to add money. The CEO of this is posted on Twitter, hold on, more money's coming in. So just very, very amazing to see the ripple effect on that. Do Kwon, there you go. Master of stablecoin Luna. Deploying more capital, steady lads, 1 hour ago. And people are saying, well, you better hurry up. Bitcoin's now sitting on 30K, Ethereum at 22, and our favorite super high risk play, Polygon, getting decimated at 83 cents. Here's a thread. Curve 3 curve is almost empty. Money is getting drained out of these different DeFi protocols currently. And again, it's happening all over the place. Big threat on Ukraine. I think just to sum it up, nobody wants to stop the war, so the energy play is intact, unfortunately, for longer. And we're talking about another $30 billion heading out there. And the defense contractors motivated for that, and the politicians. So they love to dump money to Ukraine. They've been doing it for a very long time. But huge thread about the history of all this. I'm going to skip through it. You can watch it if you like. But bottom line, our expectation is the war moves on and Boyle continues to be a good play. And I skip all the details because a lot of people get their feelings hurt. If you want to go to my Twitter feed and read through it, a lot of history on that. Okay, Alf says the moves in US real rates have been big. The chart shows the distribution of the rolling monthly changes in 5-year forward, 5-year US real. Here's where they do statistical analysis on how often this has occurred. And we're at a 3 sigma. Basically, it's never happened before. This is a very, very massive move that no one I follow thought was possible. We would just watch stocks go up constantly, interest rates go down constantly. This move I thought would happen over a period of 2 years and happened in 5 months. Caught us all off guard. Europe wants to stop Russia, but they don't know how. The only way to do it is to stop buying their energy, but to do that, it collapses their economy. So it's a lot of talk, but they're having a hard time pulling it off. Long View points out some of these individual stock moves are stunning. Netflix went from $700 to $175 in just a few months. Here's a growth of natural gas over the last 2 years, driving US prices up to support Europe. Putin did his big speech, didn't escalate, just said, you know, we're at war. Didn't go full blown enlist everyone, which is what I was afraid of, that he wouldn't do that. That's one reason why I got us out of Boyle, and it was a good move. So expect to get back into it. Looks like Putin's game is slow and steady, make the world pay for this by keeping energy costs as high as possible, as long as possible, and wear them out. And I think we will be seeing politicians fatigued probably within the next 60 days. You're going to start pissing off billions of people globally over this this fight for Ukraine. Housing market's going to start getting under trouble. This is just looking at, it says, my God, the 30-year fixed mortgage rate just hit 5.6, up 255 basis points year over year. The average home is up 20%, 511,000 versus 408. The average cost of a mortgage is now up $1,000 from $1,700 a month to $2,700 a month. So that's obviously going to put pressure on the massive housing market. So yeah, I believe we're going to have to see a big pivot very, very soon. We could be looking at a pivot from central banks within weeks or days at this point. Jim Bianco points out, year to date, the ruble is now the strongest major currency in the world. It has appreciated 9.6% against the dollar. Biden says March 26th, as a result of our unprecedented sanctions, the ruble was almost immediately reduced to rubble for a week. Okay, very good. So that's really the way we're looking at markets. Bond market is what we should focus on. This has to stabilize. Here's a look at bonds over 30 years, 40 years. And all they've done is go down over time. And this is how they grow debt. So unless we believe governments can sustain their budgets without growing debt, we need to believe this will be driven lower. And there's a lot of ways they can do it. So let's watch and see. But here we are. This is the upper bound of what I thought was potentially possible without creating chaos. It hit it, and here's the chaos. We've done an okay job hedging it for high risk with Boyle. We've done a poor job hedging safe growth by not having enough Boyle. And our private equity product did a poor job of hedging this risk. Question is, should we be worried about this going much further, or should we be getting prepared for the opposite play for the remainder of the year? Again, I think we're very close to the opposite play being the big money maker, and that if we do get back into Boyle, it'll be for a shorter period of time. Once we sell Boyle, expect to either go into treasuries, crypto, or tech. And so we're watching that news flow carefully on the war front. Okay, TLT, just another look at interest rates. This is the fun one to play for investors because it's liquid, it's in your stock trading account, you can buy put options on it, and it's below the level where I said we would have problems. The line in the sand was 120. We started buying at 125. We've been patient to add more. And yeah, if this goes any lower, I think we'll get a Fed pivot and even more pain in stocks. So keeping a close eye on it. Here's a look at the interest rates on a 30-year fixed mortgage rate. Same chart, same pattern, same reasoning. Now I'm now looking at the 3-month over 10-year instead of the 2-year over 10-year spread. This one did not invert. And that's probably why reverse repo is still at $1.9 trillion. So this one did not give us a signal of a recession. And when we look at the consumer data, it's just silly. We're having massive amounts of money and massive amounts of spending. The consumer is still strong. I don't expect corporate profits to fall off a cliff. That's why we're not believing in a doom and gloom depression crisis. We just need these interest rates to fall. And I think the stock markets will be very, very happy. Here's a look at our yield curve. Same shape, not as inverted as it has been in the past, but still the wrong shape completely. Well, the NASDAQ is still not down to the March levels. So a lot of people want to say, well, the NASDAQ's got to go up from here. But so the QQQ is at 300. Before they went into money printing, it was in the 200 to 250 range. So yeah, there could be much more pain in the NASDAQ, unfortunately. So yeah, unless we fix supply chains and mainly supply chains. I would prefer just to go long treasuries, a lot safer bet. Okay, the VIX is in the sharp downward slope, and we got a good return today, but not enough to cover this pullback whatsoever. So we've got UVXY up 12%. Reverse repos at $1.85 trillion, competing with that 3-month treasury. So a lot of money can get dumped into the markets from here. Currently sitting in the Federal Reserve's reverse repo facility. Now this is good for our predictions. Finally, we're seeing copper underperform gold. This indicates lower interest rates ahead. It's gonna be very bullish for all our products. So let's see it play out. So far, those interest rates just stay stuck. They're not falling. Okay, there's Boyle just crashing about 50%, almost 50% from that recent high where we got out. Nearly perfect timing. Very tempted to get us back in. Today, I held back. NRGU is attractive as well. But let's see. So Putin makes his money with oil, and he can wreak havoc with natural gas. He makes way more money from selling oil. So it's more likely that European countries will try to punish Putin via oil embargoes, and Putin would be more likely to punish Europe via cutting off natural gas. And so that's why we've been playing Boyle. If he cuts off natural gas, big, massive problems, especially in markets. So I think Boyle is a better war hedge than NRGU, as we expect the potential for a dramatic escalation in the next month. So most likely we'll be back into Boyle primarily once we pull the trigger on that. Lumber futures was warning us that commodities could pull back just like it did last year, and that is playing out today. We've got Boyle down 24%, NRGU down similar. Spot oil Brent down 6.6. So those lumber futures are doing a good job warning us. DXY at 103. So the bad thing about DXY at 103 is it makes bonds risky for foreigners because if the dollar doesn't stay at 103, let's say the 30-year pays out 3%, but the dollar falls in value against their currency by 3%. Well, you're not making any yield. And with the yen down 30%, if there was a strong reversion for the Japanese, well, they could be looking at a massive loss. So yeah, this is a very risky price for the dollar to be at if the government wants to sell its debt internationally. Now, to give you a feel for what the DXY can do, it can be quite a wild ride. Most of the people I follow believe we're going to see a weakening dollar over time due to twin deficits and an unproductive economy, and that we're very close to a peak. That would be Jeffrey Gundlach and Ray Dalio, who primarily make that prediction and believe that emerging markets this decade will be the big winner. So from 2001 to 2008, look at that dollar fall, 120 to 72. That's the type of move that's going to take Bitcoin to extreme new highs. You got to be patient though. In fact, Bitcoin's been only alive during a strengthening dollar primarily. Now, some of those big gains where, especially right here. So remember, crypto hit an all-time high right about here, December of 2017. Well, look what happened to the DXY. It was painful for 2 to 3 years, and then it fell. And that moved from 103, exactly where we're at today, and crypto topped right about here. We got a $100 or a $12 move down on DXY, and you got one of the best returns in cryptocurrencies in history. So if we're on the verge of a similar move, the pain we've been holding in cryptocurrencies will be short-lived. Here's those currencies going up. So now the yuan is down 6% against the dollar, and the yen 18%. So again, if they want to go buy our 30-year treasury with a 3% yield, well, they better hope that yield falls so that the value of the bond goes up, because if there's a reversion in the dollar against their currencies, they're actually be losing more than they make on the interest. Okay, so we're looking at the peak price of Polygon, which is not the peak price of Ethereum or Bitcoin, but from Polygon's top price to current crash, Polygon's now down 70%, Ethereum's now down 43, and Bitcoin's now down 38. If I go back a little further to where these peaked out, we're looking at a 41% drop in Ethereum, 46 in Bitcoin, and a 50% drop in Polygon. So ugly. Um, but let's zoom out a little bit and look at the volatility and the pattern in the chart. So if we zoom out to about 2-year stretch, we can see you made some massive money in all three of these despite the current drawdown. So with the right time horizon, these are the most profitable assets outside of Tesla in the financial markets. And Bitcoin's up 67%, Ethereum 317, Polygon up 4,000%. Now at peak, Polygon had a 14,000% return over this 2-year stretch. I've been watching Ethereum and silver, see if there's some sort of inverse correlation. Not so much yet. Haven't got us into gold or silver this year. Here's a look at interest rates going up and everything tanking. So this is becoming problematic. Banks are down, NASDAQ's down, and energy's down. Well, interest rates have been rising. So the whole system is broke. We're going to need some central bank intervention very soon to get these interest rates down. That's the problem. And the root of the problem is the energy, food inflation, and supply chain disruptions. Okay, here we have emerging markets against the S&P 500 when the dollar fell from 120 to 70, and you get a 340% gain in emerging markets against a 80% return in the S&P 500. So safe growth is positioned for that move. It's been going against us for well over a year now. And again, I think we're very close to a reversal in all of these price actions. Here's the volatility in the kings of emerging markets, Alibaba, Tencent, and Taiwan Semiconductors. So just massive moves up, massive moves down. The European index we've been investing in almost reversed all the war losses, only to give them all back and drop to new lows today. We've got rare earth metals, uranium, and copper all tanking simultaneously after having a pretty good rally here. So here's that chart. Rare earth metals getting beat up the most, down 24%. Gold and silver both crashing. These are charts. This is a chart we look at to see if there's a scalp trade, if we were to see gold going up and silver way below, potentially an easy play on silver. But I'm seeing strong job growth and strong credit growth. So I'm not looking at stagflation right now. Okay, here's that CPI print. Let's see this fall Wednesday and see if the bond market finally starts to get a bid and if this is going to be good for stocks. So at this point, pretty content in only putting the Boyle back to play, see what the CPI does, see how the market responds, and then potentially another adjustment on Thursday, maybe Wednesday. Now, I want to point out, if we had reacted to the Fed's speech last week, which made the market go up, the next 2 days it crashed, including 3. So now we're at 3 days of crashing. So it's been some crazy volatility. And it makes sense to perhaps wait a day or two after the CPI to make assumptions. Here's the job growth coming in strong. Labor growth, participation rates, it fell month over month, but still going straight up. So we'll see if they can close that gap. Now, Jeffrey Gundlach made up a term that the reason why the labor force participation rate hasn't gotten back to normal is there's a percentage of the population that has made a full-time living out of robbing stores. And there's been lots of laws passed making it very hard to prosecute these people. So just comical, but in general, we are seeing this go up. So the labor recovery looks strong. There's twice as many jobs as there are people looking for jobs. And with everybody losing their big profits on their house potentially soon and their stock market account, perhaps more people are going to have to go back to work. Okay, bank credit just had the biggest growth month over month since the lockdowns, and this is the most crazy. The consumer just borrowed $52 billion. I think this is the most in history in any print, I guess, unless we go back to this one right here. So just remarkable consumer credit growth, which will keep the consumer strong for the short term. Wages keep rising. Consumer spending keeps hitting new highs. The balance of trade keeps hitting record new levels, just mind-boggling. So this is what Jeffrey Gundlach uses to predict a lower dollar. Negative trade balance, meaning we're sending more dollars out versus bringing in from our exports. So we're importing more than we're exporting to the tune of $110 billion. And we're growing massive debts at the federal level, not to mention the private level as well. New home sales have fallen, but still at very high levels, and inventory is getting low. China's PMI just went really low. They're going to probably have to print a lot of money, primarily into real estate construction, as always, to get their targets this year. So we can see this big drop in exports and imports, but they're still at historically high levels. If I zoom out a bit, sure, it's lower, but this is still way above trend pre-lockdown. And the same thing for Chinese imports. So in general, I think if we get a good CPI print over the next 3 months and get these energy costs down, we've got a great setup for the stock market to rally from here. And I'm not expecting just a complete decimation of the US economy. There's really no reason to see that in the numbers. Okay, here's the balance sheet. When we got the big crash in crypto in 2018, interest rates were going to still rise for another 9 months until it crashed the US stock market in October. So here we go, timeline wise. This is where we get the bond market to crash everything and the Fed pivots and starts printing money. So are we going to have to pivot soon? Possibly. But more importantly, are interest rates going to go higher from here or not? If we really don't think interest rates are going to go higher from here, then we're going to most likely see technology stocks and specifically cryptocurrencies outperform everything under the sun over the coming 12 to 24 month period stretch. Meanwhile, Europe's still printing like crazy. Japan's doing yield curve control. So we've got the right setup. We just need to calm down this dang bond market. Okay, so very good. To the paid only content. If you're on a free trial, this is where your video ends. Call Dean to upgrade now at 505-322-7515. You'll gain access to our private membership area, which gives you both strategies with a calculator where you can punch in how much money you have. It'll tell you exactly how many shares to buy of each stock.